CCAPM, or consumption CAPM, as it's been known to be called, is it's basically a pretty simple theory in terms of economic intuition. When you think about the way people invest, they're trading off consuming something today versus consuming something tomorrow. And the way they make this trade-off is I can either eat more today, or I can invest in something, save, and hopefully earn a return on that investment, and then eat more tomorrow. And the reason that we think people make these decisions in this way is they're worried about states of the world when they lose their job, or there's a recession, when consuming might be very difficult. So then they'll be glad that they had saved in a previous period. So the basic model is about trading off consumption versus investment. And naturally, we think that ought to determine, since that's the way people behave, that ought to drive prices in financial markets. So the reason that a certain stock might have the price that it does versus another stock is simply because one offers a better trade-off in this consumption versus investment decision versus another. If you take a look at aggregate consumption in the U.S. and you take a look at the average stock market, just the stock market return itself, those two things ought to match up according to this theory. They don't. They don't even come close. And so the question is, are we mismeasuring some of these things? And we don't think we're mismeasuring the market as itself, the stock market. I mean, it is what it is. But maybe we're mismeasuring consumption patterns. And so that's where my research sort of starts. And we've made some progress on that. The equity premium puzzle is one manifestation of how the theory doesn't seem to match the data. So for over a couple of decades, starting with Lars Hansen, who's here at the Economics Department in Chicago, and Ken Singleton, as well as Ed Prescott and Raj Mehra, Prescott, who just won the Nobel Prize. They found that if you look at the risk-return trade-off in the stock market, again, it doesn't line up with consumption data. One reason that we've had trouble matching the theory to the data is because of this equity premium puzzle, and again, looking at the long-run consumption patterns of stockholders seems to help. If you think of two types of investment classes, bonds or stocks, investors have a choice between the two. And generally, most people would agree, and certainly seems to be true in the data, stocks tend to be riskier, but offer, on average, a higher return. Bonds, less risky, but a much lower return. Okay? Now, that sort of makes sense, and you wonder what that risk-return trade-off is to be in stocks or bonds. If you look at the standard model, this consumption-based model, which is sort of the basic building block that we have for determining why prices are what they are, it seems that the stock market is offering a much better deal than the bond market. Another way of saying this is, given the level of risk in the stock market, it's definitely higher than the bond market, but the reward for that risk seems to be so high that we don't understand why people would invest in bonds. That's the puzzle in a nutshell. Okay? Now, if you look at what people actually do, say pension funds, for instance, the average pension fund is 60% stocks, 40% bonds. So clearly, people are investing in the bond market, and that says either the model's wrong, right, or there's something wrong with the data. Instead of looking at aggregate consumption, which is for the entire economy the sum of everybody's consumption, whether they participate in the stock market or not, we take a look at the consumption patterns of only those individuals that are actually holding financial assets. So to give you an idea, if you take a look at aggregate consumption in the economy, 80% of it, or I don't know the exact percentage, but a huge portion of that is driven by people that aren't investing in the stock market. So they're not making this decision. They are making a consumption investment decision, but not through the stock or bond market. So then to try to test and match up that data with stock market data doesn't really make a lot of sense. So what we did is we took micro-level data on those that actually own stocks, that participate in financial markets, looked at their consumption patterns, and we found that worked a little bit better. Now, do we really think that people change their consumption patterns tomorrow when they see something bad happen in stock markets today? Probably not. It probably takes several quarters, maybe several years before they really adjust their consumption patterns. So the other key insight here is not only to look at those that actually buy and sell stocks, but also look at those consumption patterns over a longer horizon, not immediate response. When you combine those two things, you make significant progress on matching up the model with the data. So the key thing here is looking at the long-run consumption patterns of stockholders, of people that actually buy and sell stocks. And when you do that, which I think makes a lot of sense intuitively, you actually get some very strong predictions that match up with the consumption CAPM. Sometimes to get the right answers to macroeconomic questions, you have to take a step back and look at micro-level data. And this particular research that I'm working on is one example of that, where, again, instead of looking at aggregate statistics like aggregate consumption, think about the economic intuition and say, well, wait a minute, most of the people that are comprising that aggregate consumption don't matter for setting the prices of assets. So take a step back, go to micro-level data on stockholders, and start from there and build your way up. So what we did was we obtained evidence from the Consumer Expenditure Survey, which is a household-level survey, so that's as micro as you get, and identified each household, because they answered these surveys, whether they owned stocks and bonds or did not. Then we aggregated up all of those that said they owned stocks, and that was our measure of stockholder consumption. So sometimes you have to take a step back, look at the micro-level data to come up with a statistic, an aggregate statistic, that will allow you to address these macro questions. There's a number of things that I do that I think fit very well into the GFM. But this particular research on the consumption CAPM I think is important just for any market, so therefore it's important for global financial markets. But what we're interested in understanding is why prices are what they are. That's sort of the simplest way of putting it. For instance, why does stock A sell for a higher price than stock B? What are the return dynamics of these different assets? And this is a long-standing question that's important to any market. Again, focusing on financial markets, these are financial assets. So my paper speaks to that. It tries to understand why stocks look different than bonds, why people might prefer stocks to bonds or vice versa at different times, why among different stocks you might prefer one to the other. So I'll give you an example. We know, for instance, that small stocks tend to have higher returns on average than large stocks. Now, we also think they tend to be more volatile than large stocks, but the evidence there is somewhat debatable. Same with value and growth stocks. These are some of the biggest asset classes in the world right now that many money managers, many hedge funds, pension fund managers are pouring in tons of money. And so you hear this all the time, value stocks, growth stocks. What we know from the data is that value stocks tend to have higher returns on average and about the same level of risk as growth stocks when you measure risk in somewhat of a simple way, just the standard deviation of returns. Okay? But we need a theory that understands why is it that value stocks seem to earn higher average returns than growth stocks. And this is a big debate, not only in academia, but also in practice. When stocks in the value sector of the economy, these value stocks that we call, this is true globally as well. When they do badly, what tends to happen is that tends to predict that the consumption patterns of stockholders is going to be particularly poor in the future. Okay? Now, I'm not sure exactly why that is. This is again a starting point. We want to understand why is it that there's this link between the performance of value stocks and the subsequent growth patterns of consumption of stockholders. But the fact that it's there is very consistent with the theory, because if in fact stockholders are more sensitive to value stocks than growth stocks, they're going to price them exactly accordingly with that risk. In other words, they're going to demand a higher average return for value stocks than growth stocks. And that turns out to line up pretty well. So this is actually a major step forward, because our standard or traditional measures of risk, either looking at aggregate consumption, like I said, most people have done in the past, or even very simple measures, have not shown any differences. Suddenly, you take a look at stockholder consumption patterns and you look at it over the long run and you see a very striking difference. And that's actually, the fact that that's consistent with theory that was created 20 years ago is very satisfying. Understanding why certain sectors of the economy, particularly in financial assets, do well during certain times and poorly during others, and linking that to the fundamentals of what investors are doing, their consumption patterns, their investment patterns, is obviously something that we should all be interested in. It affects policy, it affects the allocation of resources, it affects how we think about investing internationally. So all these things are critical